Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back, everybody, for another deep dive. Today, we're going kind of beyond all the buzzwords in private credit and looking at the lower middle market direct lending.
Interesting.
We're going to explore what makes this segment tick and why it's been gaining so much interest. And most importantly, what it could mean for your portfolio. To help us really get into this, we've got the expertise of Jonathan Signetti and Jake Garmy, managing directors at Crescent Capital. They've been navigating this space for over 20 years.
Wow, 20 years. They've really seen it all. What I think is interesting about this is that the lower middle market often gets overshadowed by the upper middle market. But as Jonathan and Jake point out, there's a real compelling case to be made for this segment that's often overlooked.
Yeah, absolutely. So let's start with the basics. How do we define the lower middle market?
So Crescent defines it as companies with an annual earnings between $5 and $50 million, and that's also known as EBITDA. But it's not just about size. Jonathan and Jake really emphasize that companies in this range, they share certain characteristics that create a very unique dynamic for lenders.
So it's like a club with its own set of rules, its own culture.
Yeah, you could say that. And understanding those rules is really crucial for success in this space.
Okay.
For example, the lower middle market tends to have fewer players compared to the upper middle market.
Okay.
And this means less competition for deals, which can translate into much more favorable terms for lenders.
Fewer sharks in the water.
That's one way to look at it.
That's a good thing, right?
Absolutely. It gives lenders like Jonathan and Jake more leverage to negotiate better pricing, lower leverage ratios, and stronger covenants.
Okay, wait. Remind me again, what are covenants and why are they so important?
Covenants are basically guardrails for the lenders.
Oh.
There's specific terms that are written right into that loan agreement, and they can restrict what the borrower can and can't do. For example, a common covenant might be limiting how much debt a company can take on, or require them to maintain certain financial ratios.
Okay.
And that helps to protect the lenders from taking on too much risk.
Like an extra layer of security.
Exactly. And because the lower middle market is less crowded, lenders can often secure stronger covenants than they might in that more competitive upper middle market.
That makes sense.
And this can lead to a lower risk of default and better recovery rates if things do go wrong.
Okay. So less competition, potentially better terms.
Yeah.
What else makes this market stand out?
Well, Jonathan and Jake highlight these closer relationships that lenders can build with private equity sponsors in this space. Because it's a smaller market, there's more opportunity for collaboration and a deeper understanding of each other's goals.
It's less transactional, more about building these long-term partnerships.
Exactly. And, these close relationships can lead to better deal flow, more tailored solutions, and ultimately stronger outcomes for both the lenders and sponsors.
That makes sense. Okay, so let's talk numbers. What kind of performance are we talking about here? What do the numbers say?
Well, Jonathan and Jake point to data showing that the lower middle market has historically generated higher yields and lower default rates compared to the upper middle market.
Higher returns and lower risk. That sounds pretty promising.
Yeah.
But what's the catch?
Well, like any investment, there's always risks to consider.
Mm-hmm.
But one of the interesting things about this market is that it's shown less volatility during market downturns compared to that more broadly syndicated loan market.
So a bit more stability when the storms hit.
You could say that. And this stability stems from a few key factors. The capital structures in the lower middle market tend to be more conservative. There's less leverage involved, which acts as a buffer during economic downturns.
Okay.
Second, those stronger covenants we talked about provide that extra layer of protection.
Yeah, it's really starting to paint a picture of a segment that offers potentially higher returns, less risk, and more stability.
Exactly. And that's what's making it such a compelling opportunity for investors who are looking for something beyond the usual suspects.
Okay.
But there's another aspect that Jonathan and Jake emphasize, and that's the diversification benefit of the lower middle market.
Okay, let's dive into that. Why is diversification so important in this context?
Because the lower middle market consists of companies and sponsors that you won't find in the upper middle market. It offers a way to spread your risk more effectively.
So not putting all your eggs in one basket, as they say.
That's the idea. By diversifying across different segments of the private credit market, you can potentially reduce the impact of any single investment going sour. And Jonathan and Jake's firm, Crescent Capital, has a long history of successfully navigating this space. They've built their reputation on a disciplined credit approach, deep industry expertise, and those strong relationships with sponsors that we talked about earlier.
So it's about having the right team in your corner, especially when you're venturing into a specialized market like this.
Absolutely. And that brings us to an important question. What's driving the current interest in the lower middle market? Why is it making headlines right now?
There are a few factors at play here. One is the evolving landscape of the banking industry. Jonathan and Jake have observed that banks are pulling back from lending to smaller businesses,
Okay.
particularly in the lower middle market.
So there's a gap emerging that needs to be filled.
Exactly. And that's where private credit comes in. Firms like Crescent are stepping in to provide much-needed capital to these companies.
Okay.
And this trend is being fueled by another factor. The surge in private equity dry powder.
Hold on. What is dry powder?
It's basically the cash that private equity firms have raised, but they haven't invested it yet.
Right.
And right now, those firms are sitting on record levels of dry powder, just eager to deploy it as the M&A market heats up.
So you've got banks retreating, private equity firms flush with cash, and a whole segment of companies that are hungry for capital. That sounds like the perfect storm for the lower middle market. Yeah, it's definitely a dynamic landscape, but of course it's not without its risks. And Jonathan and Jake are very clear-eyed about the potential challenges that investors could face in this space.
Okay, let's not sugarcoat it. What are the potential pitfalls investors need to be aware of?
Well, one of the key risks that Jonathan and Jake highlight is the vulnerability of lower middle market companies to economic downturns. Because these businesses are smaller, they often have less diversification and fewer resources to weather a recession compared to their larger counterparts.
So less room for error when things get tough.
Exactly. And then there's what's known as execution risk, which is tied to the private equity sponsor's ability to successfully implement their growth strategy for that company.
So it's not just about picking the right company, it's also about picking the right sponsor with a solid plan and the expertise to execute it.
You got it. If that strategy falters, it can really ripple through to the lender's investment. So for example, imagine a sponsor that overestimates the growth potential of a company or fails to really anticipate those competitive pressures. That could lead to missed financial targets, a decline in profitability, and ultimately a higher risk of default on the loan.
Okay, so how do experienced lenders like Jonathan and Jake mitigate these risks? I'm guessing it's a little more than just crossing your fingers.
Absolutely. First and foremost, it's about partnering with those top-tier private equity sponsors.
Okay.
Those with a proven track record of success, deep industry expertise, and a strong understanding of the lower middle market.
So due diligence isn't just about the company itself. It's about scrutinizing the sponsor as well.
Precisely. It's a package deal.
Okay.
Experienced lenders also focus on building diversified portfolios.
Okay.
This means spreading their investments across different industries, geographies, and sponsor strategies to minimize the impact of any single investment going sour.
So not putting all their eggs in one basket, as they say.
Exactly. And within those portfolios, they prioritize companies with predictable cash flows. Businesses that generate steady, reliable income even during those times of economic volatility. They also keep a close eye on leverage, ensuring that companies aren't taking on more debt than they can realistically handle.
So being selective, spreading the risk, and favoring companies with a solid foundation, it sounds like a pretty prudent approach.
It's all about balancing risk and reward.
Makes sense.
And let's not forget the importance of thorough due diligence.
Yeah.
This means digging deep into the financials, the industry dynamics, the competitive landscape, and even the management team to really uncover any hidden risks before they become problems.
So knowledge is power. The more you understand about a company and its market, the better equipped you are to make those informed decisions.
Couldn't have said it better myself. And once that investment is made, it's not a set it and forget it situation. Experienced lenders like those at Crescent Capital, they engage in really active portfolio monitoring. Tracking those early warning signs and addressing them proactively before they snowball into bigger issues.
So it's like having a finger on the pulse of those investments, making adjustments as needed along the way.
Exactly. It's an ongoing process of vigilance and engagement. Now, we've talked about the market, the opportunities, the risks, and the importance of due diligence and portfolio monitoring.
Yeah.
But there's one final piece of the puzzle that we haven't addressed yet: the specific qualities that set those successful lenders apart in the lower middle market.
Okay.
Jonathan and Jake have some really valuable insights on this as well.
Okay, let's get into the details. What are the secret ingredients that make a lender stand out in this space?
Well, first and foremost, it's about having that time-tested and disciplined credit approach. This means having a well-defined framework for evaluating risk and making sound investment decisions, one that's been refined and proven over multiple economic cycles.
So experience matters. It's not just about riding the waves of a bull market. It's about navigating those inevitable choppy waters as well.
You got it. And those strong relationships with private equity sponsors that we talked about earlier, those are absolutely crucial as well. These connections, often built over years or even decades, can unlock access to some really prized deals and provide valuable insights that others might miss.
It's about trust, reputation, and that shared history of navigating the ups and downs together.
Exactly. And let's not underestimate the importance of deep industry expertise.
Uh-huh.
Lenders who truly understand the nuances of specific sectors can provide valuable guidance to sponsors and portfolio companies, helping them anticipate trends, avoid pitfalls, and capitalize on opportunities.
So it's not just about crunching numbers. It's about understanding the businesses, the markets, and the forces shaping those industries.
Absolutely. And of course, we can't forget about those robust portfolio monitoring capabilities that we talked about earlier.
Yeah.
It's all about having the systems, the data, and the expertise to track those investments closely. Identify those red flags early and make those crucial course corrections when they're needed.
It's like having a team of expert navigators guiding those investments through those sometimes uncharted waters.
That's a great analogy. And finally, there's the question of scale and balance sheet strength. Successful lenders need the financial firepower to provide certainty of execution and the capacity to support those growing companies as they scale.
It's about having the resources to be a reliable partner, not just for today's deal, but for the long haul.
Now you're getting it. So as you can see, it takes a unique blend of experience, expertise, relationships, and financial strength to really excel in the lower middle market.
It's a specialized game, and those who've mastered it are the ones who consistently come out on top.
Yeah.
But I think we've saved the most important question for last.
Yeah.
How does all of this translate into potential benefits for our listeners, the investors?
That's what we'll explore in the final part of our deep dive into the lower middle market.
Okay, so we've really explored this lower middle market with these great insights from Jonathan Signetti and Jake Garmy at Crescent Capital. We've seen its unique dynamics, the risks involved, the qualities that set successful lenders apart. But let's bring it all home. What's the bottom line for investors? Why should they be considering adding this segment to their portfolios?
It really comes down to the potential for, a more balanced and resilient investment experience. Remember those advantages we talked about? Less competition, better terms, stronger relationships.
Yep.
All of those contribute to a potentially more stable and rewarding outcome for investors.
So it's not just about chasing those highest possible returns.
Exactly. It's about finding that sweet spot of risk and reward. And as Jonathan and Jake emphasize, the lower middle market really offers that compelling combination of factors that can contribute to that balance.
Okay, let's break it down. What are the key takeaways that investors should be thinking about?
First and foremost, diversification. The lower middle market provides exposure to a whole universe of companies and sponsors that you simply won't find in those larger, more crowded segments of private credit.
So you're spreading your bets more effectively.
Precisely. This helps reduce concentration risk and can potentially smooth out those bumps in your portfolio's performance.
Makes sense.
And let's not forget about those higher yields we discussed.
Yeah.
Historically, the lower middle market has generated a premium over more traditional fixed income investments.
Okay, so higher returns, more stability. I'm starting to see the appeal. But is it realistic to expect those trends to continue?
Well, past performance is never a guarantee of future results, but there are reasons to be optimistic. Jonathan and Jake point out that the lower middle market has historically been less susceptible to repricing pressures, and those looser lending terms that we've seen kind of creep into that upper middle market.
So potentially more resilient in the face of changing market conditions.
Yeah, that's right. And there's another important factor to consider: correlation. The lower middle market tends to be less correlated with those broader public markets. This means that when the stock market takes a dip, your lower middle market investments might not necessarily follow suit.
So a potential hedge against those inevitable market swings, that could be a valuable addition to any portfolio.
It's all about finding those investments that zig when others zag. And the lower middle market has the potential to do just that. And as Jonathan and Jake highlight, this market is still evolving. It's not as efficient or as crowded as some of those larger segments, which means there's still room for those skilled lenders to generate those attractive returns.
So a bit of a frontier market within private credit. That sounds intriguing.
It's a dynamic space, that's for sure. But as with any investment, it's crucial to partner with those who truly understand the nuances of this market.
Yeah.
Firms like Crescent Capital, with their deep experience, strong relationships, and disciplined approach, they're well positioned to navigate those complexities and unlock that potential.
Well, Jonathan Signetti and Jake Army have certainly given us a lot to think about today. I feel like I've gained a whole new perspective on this often overlooked segment of the market.
It's been an enlightening deep dive, and I think it's left us with a lot to ponder. So for everyone listening out there, here's a question to consider. Given what we've learned about the lower middle market's potential for diversification, attractive yields, and relative stability, how might this segment fit into your investment strategy?
It's a question worth exploring. And who knows? Maybe your next deep dive into the world of investing will lead you right back to this intriguing corner of private credit. Until next time, keep learning, keep exploring, and keep diving deep.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.